Hi, I'm Pedro da Costa, editorial fellow here at the Peterson Institute for International Economics. We have a Fed meeting coming up this week, and who better to discuss it with than David Stockton, senior fellow here at the Peterson Institute and former chief economist at the Federal Reserve. Welcome.
Thank you, Pedro.
So, what are you expecting? Most people don't think that they're actually going to do anything this week. So, given that outlook, what is the debate inside the room likely to be like, and what are the specific points that are likely to have the most contention over, particularly given the context of global concerns that they flagged in the last meeting?
So I agree with you. I certainly think the meeting statement itself that follows the meeting is going to be relatively boring. I think the Fed is likely to acknowledge the fact that the recent labor market reports have been softer than they had been earlier and might downplay a bit some of the concerns about global and financial turmoil. But I think the meeting itself is likely to be much livelier. And there, I think the real question will revolve around, one, of course, continuing to look at how strong the global economy is and whether or not we're seeing any signs that that really is weighing more significantly on the U.S. economy than people had thought earlier. And certainly we are seeing some signs that both the strength of the dollar, maybe the weakening of the global activity is depressing U.S. exports and weighing on the economy to some extent. That's being offset by strength in the domestic side right now. Mm-hmm. But I think the real area of contention and debate at this meeting is likely to revolve around the inflation picture. I think we've seen some growing signs that there is less confidence. The Fed has been telling a story all year long that as long as the labor market continued to improve, it was going to be reasonably confident that they would see inflation move back to the 2% objective.
The confidence seems to have been waning of late.
And that confidence seems to be waning of late, and certainly we've seen a couple of governors at the board, Governor Trujillo, Governor Brainerd, express some concern about the relationship between economic activity and inflation. And I think that signals probably a deeper sense of uncertainty and a diminished sense of confidence about what that inflation picture is going to look like and how quickly, in fact, is the Fed going to move back to its 2% inflation target. You know, it's been almost a decade that they've been running below their objectives.
Sure.
So I think this is obviously an issue around which there are differences of opinions of where to take the risks at this point.
Now, do you think that we'll see any reflection of that debate in the statement? And it's relatively, in meetings where we don't have a press conference or forecast, you get a lot less information, of course. And so do you think, if any, what changes in the statement would you expect to reflect those factors that you just outlined?
So I don't think you'll see any changes in the statement with respect to the language about inflation. Mm-hmm. I think they're going to basically stick to that story. They might note that there's been some further decline in inflation compensation in financial markets. That's a measure of inflation expectations that are taken from the index bonds. But I don't think they're going to actually air that concern in the statement immediately following the meeting, where I do think, as I said earlier, that they'll acknowledge somewhat weaker labor markets. I think the minutes to this meeting that will be released in mid-November will be a better window into what that debate looked like. And I think we saw in the minutes to the September meeting the precursor to this growing concern of whether or not inflation was going to be moving back to 2%. And then I think that's been echoed since by some policymakers. On the other hand, Janet Yellen, in a speech a week right after the September meeting, pretty much stuck to her script that, in fact, declining labor market slack was going to put some upward pressure on inflation, that she still saw tightening by the end of the year, as did other members of the committee, as the most likely outcome.
So in that context, when do you see them moving, and what are kind of the risks at the moment?
So just as the Fed has little confidence about its inflation forecast, I have little confidence about this particular prediction as well. But I think the odds are better than 50-50 that we get the first rate increase by the end of the year. And I say that because enough of the center of the policymakers, including Janet Yellen and Stan Fisher and John Williams and others, have continued to suggest that the data they've seen, even most recently, still make them think the economy is strong enough that it's time to get started on that increase. But that is a balance that could easily be tipped by surprisingly low inflation data or more tangible evidence that the U.S. economy in particular, but the global economy more generally, might be slowing down more dramatically than they're expecting.
Let me ask you one last question about timing, because if the Fed moves this year, that means December, right? And there's also expectations that the ECB might ramp up its stimulus. How does the central bank factor in other actions by other major central banks? I mean, it could create some significant volatility in financial markets, I imagine, if you have two major central banks moving in opposite directions at the same time.
Yeah, it's not so much the volatility, but it would be the combination of a Fed tightening and an ECB easing that would put further upward pressure on the U.S. dollar. Mm-hmm. So the Fed has to take that into account as they make their decision, just as the ECB is going to be looking at the Fed actions in terms of calibrating its policy.
All connected.
All connected.
Thank you so much, David.
Absolutely.
Appreciate it.